We're moving on now to options pricing. This is not going to be a super long video. I'll try not to waffle on too much, but there's some really key information here to know when it comes to options pricing. So let's move on. I've touched on this, or at least I touched on intrinsic value in a past video. Options are comprised of two components, two pricing components, intrinsic and extrinsic value. Okay, those are the two primary components to an options price. Now, intrinsic value, that's that amount that in which that strike price of an option is profitable, or how much it's in the money versus the market price of the underlying asset. So if you bought something at $100, it's in the money by $10, it's up to $110. Well, it has intrinsic value of $10. And I'll show you a little graph in a second so you'll kind of see it visually. But that's all that intrinsic value is. Now, an option has intrinsic value, of course, if it's in the money. If it's in the money, it has intrinsic value because it's in the money. And that's the value that any given option would have if it was exercised today. Okay, that would, boom, that minimum value right there of if it was exercised today. Looking here at this chart, remember a call option, in this case we're talking about a call option, it gives you the ability to purchase the underlying at whatever the strike price. Let's say the strike price is $100. Regardless of how high that price may be, it may go to $500. But if you bought a call for $100, you get to buy it for $100. Doesn't matter, okay? So any price above the strike price for a call is going to be in the money. This could be $101. It'd be $1 in the money. It's $105. It'd be $5 in the money. $110. It's $10 in the money. It has $10 of intrinsic value. And as I've often said, calls and puts are basically mirror images of each other. So in this case, if you bought a put with a $100 strike price and the price goes down, fantastic. Now it has intrinsic value. If it went down to $90, it would have $10 of intrinsic value. What happened if that price went up? It would have no intrinsic value. It'd be worth zero intrinsically. So we can say that the intrinsic value is basically the inherent worth of an option. Okay, that's the given. There's no questions. That's what it's worth minimum. No questions, because we can see that. That's the amount that the option is in the money. Now, the extrinsic value, this is a little bit different. This is kind of cool. This is also referred to as time value. And this is very, very important for options traders, both for what we do, or we're selling options most of the time, and for buyers, as you're going to see. It's the difference between the options price, the premium, whatever you paid for, and its extrinsic value. So we could say that an option's extrinsic value or the time value is that part of the options premium that is associated with the potential for that option to become more valuable before it reaches expiration. Now, the longer the time to expiry, the more extrinsic value it's going to have, right? Because it's going to have more time to become valuable. If you've got 1 or 2 days to expiry, it's probably not going to move as much. But if you've got 90 days to expiry, who knows what can happen in 90 days, right? So it's going to have more extrinsic, more time value associated with it. So an option can have zero intrinsic value. Intrinsically, it can be worth nothing. You bought a $100 call thinking it's going to go up. Yeah, it goes down to 90. It's worth zero intrinsically, but there's extrinsic value there, because if you've got 60 days to expiry, that thing might be $120 in 60 days. So there's time value. It's still worth something. The other thing that's very, very important and a big part of that extrinsic component is volatility. The more volatile the underlying asset, the higher the time premium. If I'm trading something that hardly moves at all, doesn't matter if it's 30 days or 60 days to expiry, chances are it's not going to move very much. But if I'm trading something that's going nuts, like it's all over the place, who knows? All bets are off. If I'm selling that option, I want a lot more premium because that's more risk for me, right? So that's sort of that option pricing component. I made a little chart here. So let's just say the total premium of this option. This option is selling, or it's trading for $1.30. It's an option on some stock, for example. It's trading at $1.30. The stock price is $15, let's just say. And this is a call option, the strike price of $14. So whether you bought it today, whether you bought it weeks ago, you bought a call with a strike price of $14, hoping it's going to go up. Hey, it went up. It's at $15. It's got $1 of intrinsic value. It's worth $1 no matter what. Well, why is it $1.30? Well, it's $1.30 because of the extrinsic value. It's got some time to expiry, right? It's got some time to move around. It might go lower, it might go higher. Who knows? That's the basics of the options value, extrinsic and intrinsic value. So I'm going to show you next basically a graphical representation of an options chain. What you'll see with any online broker, they all look fairly the same, and you'll see exactly what I mean. So this is Coca-Cola. I don't know why I'm picking on Coca-Cola. I used it in the last video too, but whatever. Here's an options chain. Don't worry. This looks confusing. If you've never seen this, you'd be like, oh my God, Shane, what is all these numbers everywhere? I'm not a data scientist, for God's sakes, man. What are you doing to me? Look, don't worry about that. Piece by piece, it's all going to make perfect sense. This is a very basic representation. Look, these are calls on the left, puts on the right. We've talked about that before. So all this strike price is down the middle, and then all the data is on the left for the strike for those calls. All the data on the right is for the puts. Simple, okay? The underlying price, the price of Coca-Cola, when this screenshot was taken, was $43.74. So the market price, $43.74. Let's say we had a 40 strike call. We bought a 40 strike call. Maybe we bought it a week. Maybe we bought it 2 months ago. Who knows? What? Maybe we're going to buy it tomorrow. I don't know. That 43.74 is the actual value. 40 strike, the difference of $3.74. But that option, what's it trading at? It's trading at I'll just say 405. Here's the bid. There's the offer. So here's the highest anybody's willing to buy it for. Here's the lowest anybody's willing to sell it for. It's got a 10-cent spread. Remember we talked about the spread? Bid, ask, difference between two, spread. So let's just cut it in half. I'll say it's trading at $4.05, right? So 31 cents of that is extrinsic value, right? The difference. So it's in the money. This thing is in the money by $3.74, but it's worth $4.05. So that extra little bit of value, where does that come from? Well, that's time value. And part of that time value is volatility as well, but we'll talk about those things later. Now, obviously, as this thing gets closer and closer to the expiry date, this extra little bit of time value, that 31 cents that's built in there, that's going to shrink every single day as we get closer and closer to June 15 when these things expire. That makes sense because there's less and less time for that option to expire in the money, less and less time for it to move around, right? Now, you'll see anomalies like with stocks, for example. Let's say Coca-Cola is coming out with earnings in 2 days. Well, these premiums would be rough. This 31 cents might be 71 cents. Who knows? Because there's a lot more confusion. People are like, hey, I don't know what's going to happen with earnings. Are they going to make their earnings or are they going to miss? Who knows, right? So there's expected volatility that get priced in. The people who sell those options are like, hey, I'm not taking 31 cents for it. Anything could happen when they release their earnings. I want 50 cents. I want 70 cents, whatever. So you'll see how these options prices change according to all these different circumstances. So next up is time decay. And time decay is a measure of the rate of decline in the value of an option due to the passage of time. Now, I've alluded to this quite a few times, and I'll keep doing that. We're going to hammer everything in. We're going to repeat. Time decay is a beautiful thing if you're a short seller or if you're selling. Doesn't work so good if you're buying, but it's a beautiful thing if you're selling. And I'll show you why. Now, time decay, it's interesting because it accelerates as an option's time to expiry draws closer and closer because there's less time to realize a profit from that trade, right? In that last example I showed you, if you're 3 days from expiry, there's going to be very little extrinsic value left, very little time value left. If it's got 3 months to expiry, who knows what can happen, right? So there's a lot more time value built in there. But a lot of people think that decay is linear. Every day it loses, 2 cents, or whatever it happens to be. Nope, that's actually not the case with options. They're not really linear. And here's a little chart. Now this chart, this is a simplified chart showing time decay. As you can see, it's not linear. If it was linear, there'd just be a straight line going from here, down to there, right? Just be a straight line. As an option nears expiration, the time value starts to erode or to decay at an accelerated rate. It's much, much more rapid. And as you can see, right around the 30-day mark, boom, it falls off a cliff, right? It really starts to, it sort of starts going down a bit more around 90 days, 60 days. It picks, this is, hopefully you can read this. It's a little bit blurry. Maybe it's because I don't have my glasses on, but 90 days it starts to go down. 60 days picks up a little bit more steam, but it really falls off that cliff around 30 days. And there's plenty of strategies out there on when to sell options. Now, this can work for you or it can work against you. Everything with options has a has a plus and minus, a yin and yang, a gimme and a gotcha, right? Depending on whether you're long or short, did you buy the thing or did you sell the thing? It's going to make a difference, right? Now consider this. Where the options decay is the steepest, what would you generally prefer to be doing? Where it falls off here, do you want to be long this option? You want to be short because it's getting worth less and less. The value is just bleeding out of it super, super fast, right? Now there's dangers in there. There's things we're going to talk about. And that's not to say you can't buy an option here and sell it for a lot more. You can, but generally speaking, you want to be short options as the time decays. Similarly, let's say I like to buy options. If I buy an option way out here, there's going to be hardly any time value decaying. I've got some time to make a decision, and maybe maybe I'm thinking something's going to go up, and I buy a call, and I'm holding it. The thing's not moving much. Apple shares or something, it's just not moving much, not much. I might decide to get rid of it. I'll sell it, maybe take a small loss here, versus waiting till it really starts to lose value here. I gave it some time, didn't do what I thought it was going to do. My ideas changed, whatever. That doesn't mean that people don't hold options right to expiration. Yes, sometimes they do. If you're holding it as insurance or hedging, yes, you would hold it to expiry. But if you're speculating, you might want to get in and out here as your mind changes. Now, again, that doesn't mean you can't buy options anywhere else in the curve. But just to give you an idea, to get you to start thinking about, all right, this time decay is a big deal. It's a big part of options. And it's something we're going to talk about in quite a bit of detail in a later video. So volatility, how much that underlying asset moves around, the magnitude of the swings in price. Right now, this is 2022. It's the autumn of 2022. Oil, natural gas, gold, Tesla, Bitcoin, Ether. There's a lot of really volatile assets out there. Even the market, even the indices have been moving around a lot, very, very volatile. So the volatility is quite high. It can be both a blessing and a curse. Again, there's a yin and yang with everything with options or even with trading. But as you're going to learn, we use that volatility to our advantage. When I'm talking about volatility here, on the left side here, here's a whole high volatility asset. This can be any asset, doesn't matter. Obviously this isn't, a penny move each way, who knows, it doesn't matter. But you've got these big mountains and big valleys versus something kind of that doesn't move very much. So this is a high volatility asset. It presents opportunities on both sides of the equations, right? You can try and catch those big swings by buying, and you can sell it and catch the big swings. You can also sell options and you get more premium. Remember, with higher volatility, you get more premium. It all can work for you if it's done properly. There's some amount of timing that we have to think about. But consider this. The volatility, as you expect, is going to change. Okay? It's not going to just stay at one volatility level. There's different ways to measure volatility we'll talk about later. It might be very high for a short period of time. There's something happened with a company. The CEO got arrested. They've got supply chain problems. With cryptocurrency, a country just starts accepting it as payment, or who knows. There's all kinds of things which affect prices day in and day out that we can't anticipate, right? The markets can be very, very random. So let's say we've got this high volatility, and then things start to calm down. Goes back to more of its historical normal. That's a great thing if you're selling volatility. You wait till things get all crazy and accelerated. That's when you sell volatility. Things calm down. They always do. You buy it back at a cheaper price. A lot of our strategies center around volatility and selling volatility. That's primarily what we're doing when we're looking to earn what we consider to be a consistent income. And there's plenty of strategies out there for darn near anything, as you're going to see. Now the chart on the right, this low volatility asset, well, that's a different ball of wax. I mean, if you sell volatility in a low volatility environment, you're in trouble if it spikes, right? You sold low and buy high. No, we want to do it the other way. We want to sell high, buy low, or buy low, sell high. We don't want to do it the other way. So if you are selling volatility in a low environment, there's things we can do. Because maybe we expect this thing to stay like this for 6 months. Well, let's make it pay us for 6 months if we can do that. What we'll do is we'll limit our risk. We'll go in with a much smaller size, expecting, hey, it must bust out. Maybe we can play both sides of the market, and I'll show you that. Maybe we can put insurance on. I'm going to show you that too. There's a lot of things you can do. It doesn't have to be high volatility, but when there is high volatility, take advantage of it. Low volatility, or when it's in a range, there's things we can do as well. But if you remember from our time decay chart, the moment you buy that option, the second you buy it, what happens? is that value starts to slowly bleed out of that extrinsic value. Yes, it's not coming out very fast. If you're 3, 4, 5, 6, 7, 8, 9 months out, it's slow, but it starts to accelerate as you get closer and closer to expiry. So the moment you buy an option, you've got time working against you. The moment you sell an option, time is working for you. So I like time working for me, but there's times and places to do everything. There's strategies around each. So if you're writing or if you're selling options, you want to sell high, buy low. Makes sense, right? If you're buying, you want to buy low, sell high, ideally. It doesn't always work out that way exactly. And there's 100 iterations to this. There's ways we can fix it. But I hope this gives you an idea of how volatility affects the extrinsic value of an option. And now you understand options, how they're made up of those two primary components, that intrinsic value, which is never going to change. That's how much it's worth. That's the difference between the strike price and how much it's in the money. Okay, that's never going to change. You can't take that away from it. The extra amount of value in there is the extrinsic value. How much time and how volatile. Those are the two main components that determine that extra little bit that you may or may not be getting.
So volatility for me is the most interesting component of option pricing. And it's a little bit complicated, and don't worry, we've got a whole section on this coming up. But fundamentally, volatility of a stock price is a measure of how aggressively it tends to move over time. And in fact, volatility and the time to expiry of an option are the two largest factors in determining that option's value. And the reason for that is that the bigger jumps the stock price is likely to make every day over the more days, then the wider range of prices that that stock could get to in at the end of that time period. So, for example, over a week, if the option price the stock price can only move by 1% per day, then the furthest that stock can move in a week is 7%. But if the same stock is moving 1% a day for a year, then that could be 360% in a year. So, and that 360% could be up or down.